Gold is holding on to gains this first trading day of the quarter, and with me now is Maxwell Gold of ETF Securities. Maxwell, thanks so much for joining us.
Thanks for having me.
So gold off to a good start here as we're speaking, above $12.50 an ounce. How do you see it set up this first trading day of the quarter?
So certainly we've seen a big response in terms of support above that 1250 level. And overall, we see the trading range this year at between 1200 and 1300 an ounce as part of our base case. Also, if you take into account there's a lot of pent-up short positioning, which have been averaging on adding to those positions since the election with an average price of about 1210, 1215. So I think that builds up the potential for further short covering in the next coming weeks if we do see further support and a rise beyond 1250.
Now, Maxwell, I know we were speaking offline about myths and gold, and one thing we hear often, well, if the dollar is strong and we see higher interest rates, this will affect gold, but you say not necessarily.
So we've seen some periods when the dollar and gold actually move in sync. A great example is during another tightening period by the Fed between 2004 and 2006, when we saw a rise in the dollar in sync with a rise of gold. Additionally, people think of rates and they look at the 10-year rate, the U.S. Treasury rate, and what's important really for gold and what drives that is a real interest rate. So taking that nominal rate measure and extrapolating out or stripping out the rate of inflation. And certainly we see those real rates remain low and negative on a 2-year and 5-year basis, and even on a 10-year basis, real rates are only at about 40%. And historically, gold performs positively on average going back to 1976 when real interest rates are below 2%, so certainly more room to run, particularly with rising inflation.
So what do you feel would be a hurdle to gold then, with the dollar and the higher rates aside? What would it be for you?
So I think the biggest potential downside risk for gold this year is if we do see a further tightening, a quicker tightening by the Fed. I think that's certainly, they've been mentioning about 3 hikes this year, and I think that's been priced in the markets already, but if they decide to accelerate, if they get further positive economic news in terms of labor markets, in terms of growth, that could potentially accelerate their tightening cycle. And I think that is a potential risk for gold.
Now you mentioned 1215 to 1300 is your forecast for, we're almost at 1250, so for the remainder of the year.
So we see the trading range between 12 and 1300. Our base case is pretty much where we are right now at about 1230, 1240 as our fair value. But we do see a bullish scenario where if the Fed becomes a further dovish, if we see the dollar begin to weaken out and not moving in line with further tightening by the Fed, or if they decide to slow their tightening path, that could potentially boost gold up to closer to 1375, 1400.
Do you feel that gold is the strongest amongst the metals, or is there another metal you think we should be watching here?
So I think gold gets a lot of attention, but so far this year, most constructive, I'm looking at actually silver. I think silver has a lot further upside potential, driven primarily by its industrial applications. About 50% of annual demand for silver is tied towards electronics, solar panels, ethylene oxide catalysts, a lot of industrial sensitive inputs. And when you take into account the rise of industrial production, increase in manufacturing, rise of trade, that should be a boost for silver.
All right, so you're thinking $20
so
easy here?
Our base case for silver over the next 12 months is about 21 per ounce. So it's further another about 13 to 15% upside from current prices.
Maxwell Gold, I love the name.
Thank you
ETF
very
Securities,
much.
Thanks for joining us in studio. And thanks for watching this edition of Kitco's Gold Report. We'll see you next with Peter Hugg.